It was never the Federal Reserve. It was never inflation. And it definitely wasn't your credit score. If you've been sitting there wondering why mortgage rates refuse to come down even after the Fed cuts interest rates, the answer isn't in Washington. It's buried in a part of the bond market almost nobody outside of Wall Street ever looks at. And once you understand it, you'll never trust another headline that says rate cuts are coming the same way again. Because here's the uncomfortable truth. The Federal Reserve doesn't actually set your mortgage rate. Not directly, not even close. And the sooner you understand this, the sooner you'll stop waiting for a rate cut that might not save you a single dollar. Let's rewind to how most people think this works. The Fed cuts rates, borrowing gets cheaper, and mortgage rates fall. Clean, simple, and mostly wrong. That story works for things like credit cards and car loans, which are tied to short-term rates the Fed actually controls. But your mortgage isn't priced off the Fed's overnight rate. It's priced off something called the 10-year Treasury yield. And that number isn't set by Jerome Powell. It's set by supply and demand in the bond market, just like the price of anything else you'd buy at a store. So who's actually setting the price? Investors, massive ones, pension funds, insurance companies, foreign governments, and banks who buy long-term government debt because it's supposed to be the safest asset on earth. And for decades, there was an enormous, dependable buyer of that debt. Foreign countries running trade surpluses, recycling their dollars right back into U.S. treasuries. That demand kept yields low, and low yields meant cheap mortgages. But that demand has been quietly drying up. And when the buyers disappear, the price of borrowing goes up, whether the Fed wants it to or not. Here's an easy way to picture it. Meet Sarah. Sarah runs a mid-size pension fund, and for the last 20 years, her go-to move was simple. Buy safe, boring U.S. Treasury bonds, collect a steady yield, sleep easy at night. But now Sarah's looking at a U.S. government running trillion-dollar annual deficits, issuing more debt every single quarter just to keep the lights on. Sarah still wants safety, but she also wants to actually get paid for the risk of holding that debt for 30 years. So she starts demanding a higher yield before she'll buy. Multiply Sarah by thousands of institutions across the globe, and you get a bond market that's repricing risk in real time. And when yields on the 10-year Treasury rise, mortgage rates rise right along with them, because lenders price mortgages as a spread on top of that benchmark. This is why you can watch the Fed cut its rate 3 times in a row and still see your mortgage quote barely budge. The short end of the curve is moving. The long end, the part that actually determines your monthly payment, is being driven by something completely different. How much new debt the government is issuing, and how eager the world still is to buy it. And right now, that eagerness is fading. The math has genuinely changed. When yields on safe government debt were near zero for over a decade, adding a little more debt didn't move the needle much. But we're way past that now. Every additional trillion in new issuance means someone, somewhere, has to be convinced to buy it. And convincing people to buy something they're less excited about requires a better price. In bonds, a better price means a higher yield. And a higher yield on the 10-year is the direct pipeline into a higher mortgage rate. This is also why housing affordability isn't magically going to fix itself the moment the Fed starts easing. If the government keeps running enormous deficits, and if the traditional buyers of that debt keep stepping back, the long end of the curve can stay stubbornly high, even in a rate-cutting cycle. That's called a steepening yield curve, and it's exactly the kind of setup that quietly breaks the rates will fall soon narrative that gets repeated on financial news every single day. And it's not just mortgages that get hit. When long-term yields stay elevated, it ripples through everything. Corporate borrowing costs stay high, which slows business expansion and hiring. Stock valuations get compressed because analysts use long-term yields to discount future company earnings back to today's dollars. Refinancing activity grinds to a halt because nobody wants to trade a 3% mortgage for a 7% one. And home transactions slow down across the board because both buyers and sellers get stuck waiting for a market that isn't coming back the way they remember it. So why does nobody talk about this? Because the bond market's supply-demand dynamics are repricing long-duration risk. Doesn't exactly trend on social media. It's not a clean, angry headline. It requires actual patience to understand, and patience doesn't get clicks. So instead, we get the oversimplified version every single time. The Fed cut rates, so everything should get cheaper now. And when it doesn't, people are left confused, blaming greedy banks or price gouging, when the real answer is sitting quietly in the bond market the whole time. Here's the part that should really get your attention. If the pool of reliable buyers for U.S. debt keeps shrinking, that's not a one-time story. It's a structural shift. And a structural shift means this isn't a temporary blip you wait out for 6 months. It's the new normal you plan around. Which means, if you're waiting for mortgage rates to casually drift back down to pandemic-era lows because the Fed said rate cut, you might be waiting a very, very long time. The system has genuinely changed. We've had decades of getting used to cheap, abundant government borrowing, keeping every other rate in the economy artificially low. That era depended on the world being endlessly hungry for U.S. debt, no matter the price. That assumption is now being tested in real time. And every auction of new Treasury debt is basically a stress test for whether the old system still holds. So the next time you hear that the Fed is cutting rates and see headlines promising relief is finally here, ask yourself the question. Almost nobody in traditional financial media is asking, who's actually buying all this new debt? And at what price are they willing to do it? Because that question, not the Fed's press conference, is the one that actually determines what your mortgage rate looks like next year. And that's exactly why this channel exists, because the real risks in this economy aren't the loud, obvious ones getting screamed about on cable news. They're the quiet, structural ones hiding in plain sight in places like the bond market that almost nobody bothers to explain. If you want to actually understand what's shaping your financial life instead of just reacting to headlines, hit subscribe, because I'll keep covering the stuff that traditional financial media won't.